Okay, so let's unpack this. We're talking about the journey of an exchange operator that really started life in a smoking lounge.
Right.
It was conceived as this radical idea to fix a really broken market. And
Mm.
now it runs trading venues across 3 continents.
It's an incredible arc.
And this isn't just a tale of standard corporate growth. It's a story of constant reinvention, of creating intellectual property, and arguably one of the most aggressive acquisition strategies the financial world has seen in the last decade.
That's exactly the frame we need.
Mm.
Today, we are doing a deep dive into Cboe Global Markets, Inc., the powerhouse that a lot of veteran traders, they still just call it Cboe Holdings.
Old habits die hard.
They do. And our mission today is critical. We want to trace its history from that pivotal, really revolutionary beginning when it standardized this messy, chaotic, over-the-counter options market all the way to its modern incarnation as a true global giant.
And when we say giant, we're not exaggerating. The scale is. It's undeniable at this point. This is not just an American story anymore.
Oh, far from it. Cboe today operates this vast, very complex portfolio of exchanges and trading venues. And they cover pretty much every major asset class you can think of.
Equities, options.
Equities, options, futures, and very significantly, digital assets. Their footprint spans North America, Europe, and the Asia-Pacific region.
And just to put some numbers on that scale for you.
Yeah, let's anchor it. If you look at their 2024 financials, they posted revenue of US $4.09 billion.
$4 billion.
That led to a net income of US $765 million. So this is a top-tier financial market utility we're talking about.
Okay, so $4 billion revenue. That tells you they've moved way beyond just trading options in Chicago. But to understand the complexity now, I think we have to go back to that foundational, almost simple idea.
Absolutely.
What was the market actually like before Cboe existed, and what was the big problem they were trying to solve?
The world before 1973, the year Cboe launched, it would be unrecognizable, in terms of how derivatives were traded. Options on stocks existed, sure, but they were almost exclusively traded in this decentralized, very opaque over-the-counter market, an OTC market.
And that was mostly based out of New York.
Largely, yes.
So when you say over-the-counter, for anyone listening who might be less familiar, what does that really mean in practical terms for a trader back then?
It meant profound inefficiency and systemic risk. So you, as a buyer, had to go and establish a direct personal link with the seller.
A phone call, a handshake.
Exactly. And crucially, every single contract was bespoke. The expiration date, the strike price, all the terms of sale. They were all individually negotiated between the two parties.
It sounds more like buying a piece of art or something.
It was. It was like commissioning a unique piece of furniture. Every single transaction was one of a kind. It wasn't fungible. And it required complex, specialized documentation for every single trade.
That sounds absolutely crippling for liquidity. If I wanted to sell my contract, I didn't just need to find a buyer. I needed to find a buyer who wanted my exact contract with my exact bespoke terms.
Yes, which is almost impossible.
So the market must have been inherently small, just for a handful of well-connected, wealthy institutions.
Exactly. It completely lacked what we call fungibility.
Yeah.
And without fungibility, you can't have true price discovery. And you certainly can't have mass market participation.
And then there's the risk.
Oh, the counterparty risk was huge. That's the risk that the person on the other side of your trade just won't honor the contract. That risk created this massive barrier to market growth, and it made hedging really difficult for even institutional traders.
Okay, so into this mess steps a visionary who sees a simple solution to this massive problem.
That would be Edmund Eddie O'Connor. He was the vice chairman of the Chicago Board of Trade, the CBOT, and he's the one who developed the idea for a centralized options exchange back in 1969.
And what was his insight? He saw how other markets were working.
He saw the successful standardization models that were being used in the commodities futures market right there in Chicago. And he realized that same concept could be applied to equity options.
So his innovation wasn't just about creating a new building to trade in. It was a fundamental shift in the plumbing of the transaction itself.
Precisely. The core concept O'Connor championed was just brilliant in its simplicity and its effectiveness. It was the use of a central clearinghouse.
The OCC, the Options Clearing Corporation.
That's the one. And it would act as the counterparty to every single trade. So when you bought an option, you weren't actually buying it from another trader. You were buying it from the clearinghouse.
And when you sold it to the clearinghouse.
Right.
That immediately eliminates counterparty risk for the individual traders. The whole market can suddenly scale because everybody's dealing with one reliable central entity.
It didn't just eliminate that risk, it enforced the standardization that was so essential for that scale. The
Mm.
terms, the expiration dates, the strike price intervals, they became unified.
So all the bespoke negotiation just vanishes.
It vanishes. And once contracts are fungible and standardized, that's when a mathematical revolution can happen. Because standard contracts are the prerequisite for sophisticated pricing models,
Like the Black-Scholes model.
which would soon come to define the entire derivatives world. It needed standardized inputs to work.
So the creation of Cboe wasn't just an administrative fix, it was an enabling technology that cleared the path for modern financial engineering. But, fixing the math is one thing. Getting permission to launch a massive new financial market is something else entirely.
And the regulatory resistance was immense. I mean, this idea of trading options on an exchange, it faced huge skepticism, outright opposition even,
Especially from the SEC.
especially from officials at the Securities and Exchange Commission. They viewed this radical departure from the established New York OTC system as a potential generator of new, uncontrolled systemic risk.
They were worried about investor protection, I assume. Manipulation.
All of the above. They were deeply concerned about manipulation in a totally new and untested structure.
So it sounds like a bureaucratic logjam. How did the CBOT manage to navigate that resistance and convince the SEC to take the risk?
Well, the CBOT knew the idea was sound, but they needed credibility, and they needed diplomatic skill. So they hired a man named Joseph Sullivan specifically to address the regulators' concerns.
He was the lobbyist, the advocate.
He was. He had to lobby effectively, present the concept not just to regulators, but to the skeptical New York brokerage community too. Sullivan essentially became the chief political advocate, tasked with translating the complex mechanics into terms that would reassure these very risk-averse regulators.
And I imagine the regulatory clock ran very, very slowly. How long did it take for Sullivan's efforts to finally pay off?
The turning point came in October 1971. After nearly 2 years of intensive negotiation, presentations, and just mountains of paperwork, the SEC finally approved the effort.
Wow, 2 years.
And with that regulatory green light, the infrastructure was established pretty rapidly. The Chicago Board Options Exchange, the CBOE, was incorporated in February 1972 as an independent body. It had its own bylaws, separate from the CBOT.
And Joseph Sullivan, the tireless advocate?
Naturally, he became its first president.
The stage was set, and they chose a launch date that was packed with symbolism.
They did, April 26, 1973. And that date was specifically chosen because it marked the 125th birthday of its parent organization, the Chicago Board of Trade.
That's a great touch. A way to honor the CBOT's history while launching something brand new.
It was. But here's this historical footnote that I think truly captures the scrappy entrepreneurial spirit of Chicago finance. Where did this monumental, system-changing exchange actually begin trading?
You mentioned it at the top, the smoking lounge.
Yes, the former CBOT smoking lounge. I mean, just try to imagine that scene. One of the most significant revolutions in modern financial products, standardized, cleared options, was literally born in a room that had been designed for taking a smoke break.
It's a humble start, almost irreverent, really. It perfectly captures that spirit of Chicago challenging the New York establishment.
It really does.
And that humility vanished pretty quickly because the standardization worked.
Right.
The market was clearly just starved for this kind of efficiency.
The demand wasn't just present, it was explosive. In CBOE's first full month of operation, which was May of 1973, they traded 34,599 contracts.
Which was a clear validation.
A very clear validation. But look at the trajectory. Just 3 years later, by 1976, the monthly volume had soared to 1.5 million contracts.
A 40-fold increase in volume in 3 years.
Yes.
That metric just confirms that the old OTC system wasn't just inefficient, it was fundamentally broken. And CBOE provided the solution that institutional players were desperately waiting for.
That kind of rapid acceleration just proves that the concept of fungibility and central clearing unlocked this massive latent demand. It allowed brokers and institutions to hedge complex risks, and it let them introduce options into broader investment strategies for the very first time.
And CBOE continued operating within the CBOT building for a while, right? Tied closely to its origin point.
They did, for about a decade,
Huh.
until 1984 when they finally moved to 400 South LaSalle Street, a dedicated next-generation headquarters that allowed them to really expand their operations and solidify their independence.
So that relocation, it marks the transition from the scrappy, innovative startup phase to a mature, major independent force in the Chicago derivatives landscape.
It does. And that move sets the stage perfectly for the next great pivot.
Because once Cboe cemented its physical independence in '84, it turned its attention from the how of trading to the what of trading. And that led them directly into the realm of intellectual property and risk modeling.
Exactly. We shift from standardizing the product to inventing the metric.
And here's where it gets really interesting, because Cboe didn't just provide a venue for trading derivatives. It invented the way the entire global financial world measures and trades market uncertainty.
We are talking, of course, about the VIX.
The financial market's global fear gauge.
The Cboe Volatility Index, or VIX, was introduced on January 19, 1993. And it was. It was a revolutionary piece of intellectual property developed by a finance professor, Robert E. Whaley.
And its impact really can't be overstated.
Not at all. Before the VIX, any measure of market risk was backward-looking. It relied on historical stock price fluctuations. The VIX was forward-looking.
Okay, so how is it forward-looking? What exactly is the VIX measuring that makes it different?
It measures the 30-day implied volatility of a major stock index. And implied volatility is the volatility that is, well, implied by the current market prices of the options on that index.
So traders are basically pricing their expectations of future turbulence into what they're willing to pay for options.
That's it. The VIX takes all those prices, it aggregates them, and it distills the market's collective forward-looking expectation of uncertainty over the next month into a single number.
It's a pretty sophisticated calculation. When it first launched, what index was it tracking, and why did they pick that one?
The original VIX was designed to measure the implied volatility of options based on the S&P 100 index, which is known by its ticker OEX.
OEX options, a classic.
And OEX was chosen because it was highly liquid, and Cboe had successfully pioneered its trading, so it was really the natural starting point for them.
But the architecture of the index changed about a decade later. In 2003, they made a critical and very lasting shift.
That's right. In 2003, Cboe made the pivotal decision to change the underlying benchmark from the S&P 100 to the much broader and much more representative S&P 500.
And that change was crucial for its longevity and success.
Oh, absolutely.
Why was the S&P 500 a superior benchmark for this, especially if you're thinking about creating a tradable product from it?
Well, it was mathematically necessary for robustness and for liquidity. The new methodology, applying to the S&P 500, it incorporated a much wider range of out-of-the-money put and call options across several expiration dates.
So it's a cleaner signal.
It created a measure that was less dependent on a specific options pricing model and more purely reflective of the market's expected variance. And the S&P 500 itself, being the broadest market measure, just provided the depth and the liquidity needed to make the index truly reflective of systemic risk across the entire U.S. economy.
So that shift made the VIX a much better candidate for becoming a tradable asset in its own right.
It did. So Cboe had this mathematically elegant, highly predictive index. But the true genius, as you said earlier, was turning that metric into a financial instrument that people could actually take a position on.
Right, and that's what solidified Cboe's role as an intellectual pioneer. They moved so far beyond just providing a neutral trading venue.
They recognized that if volatility itself was a measure of risk, there should be a way to hedge that risk directly, or even speculate on future uncertainty.
What was the specific product they launched first, and what was the catalyst for that launch?
They launched VIX futures contracts in early 2004. And this allows institutions to essentially bet on or hedge against the future level of volatility, 30, 60, or 90 days out.
And the catalyst was interesting. It wasn't just an internal idea.
No, it was very telling. It followed a survey that shows significant and aggressive interest from institutional players. And the survey specifically cited the strong demand being expressed by salespeople at Goldman Sachs.
That's a great anecdote. When high-volume professional houses start signaling that they need a specific product to manage risk, you have a blockbuster idea.
You really do.
And VIX futures allowed sophisticated investors to manage systematic market risk without having to trade individual stocks or options, correct?
Precisely. It introduced a completely new dimension to risk management. Before VIX futures, hedging systematic market variance was cumbersome. It required these complicated portfolios. Now you could just directly buy or sell future uncertainty.
That move must have transformed Cboe's business profile overnight.
It did. It moved them definitively into the high-margin, proprietary index and volatility trading space. It was huge.
And that momentum, from standardization to proprietary index innovation, it really set the stage for the next and maybe most defining era of the company. this massive, relentless corporate evolution driven by global acquisitions.
The 2010s and the early 2020s were completely defined by Cboe's drive to become truly global and multi-asset, and that required serious money and a very aggressive M&A strategy.
Let's start with the corporate structure shift. Cboe began as a member-owned exchange, but the pressure to access public capital for growth and for technology upgrades eventually led them to the public market.
It was an essential transition for them to make. Cboe launched its initial public offering, its IPO, on NASDAQ on June 15, 2010.
And that gave them the war chest they needed.
It gave them the war chest they needed to fund the upcoming technological and geographical expansion. But 8 years later, in 2018, they made a very symbolic move. They delisted their shares from NASDAQ and listed them exclusively on their own exchange.
That feels like a powerful statement of self-reliance. It's like saying, our platform is good enough to host ourselves.
It was a huge vote of confidence in their own technology. And to reflect their growing global ambitions, in October of 2017, the company rebranded.
From Cboe Holdings to Cboe Global Markets.
That Global Markets title, it wasn't just aspirational. It was a clear signal of the operational mandate they were pursuing through these massive acquisitions.
Before we dig into that M&A spree, let's quickly touch on their physical presence, because their strategy with their headquarters tells a great story about balancing high-speed technology with deeply held tradition.
That dichotomy is so central to Cboe's identity. In 2019, Cboe announced this major relocation of its corporate headquarters to the historic Old Chicago main post office.
Which suggests a move toward a sleek, modern, data-driven corporate environment, emphasizing their digital future.
Right, but at the same time, they were making a very visible commitment to their past.
Right, because concurrently, they announced that a brand new, highly visible trading floor would be constructed back in their ancestral home.
The Chicago Board of Trade building.
Huh.
And this new trading floor, which opened in June 2022, it maintains the open outcry format.
So the administrative and technological brain moves to a modern high-rise, but the symbolic, traditional trading heart returns to the CBOT.
It's a brilliant strategic move. I mean, while the vast majority of volume is electronic, that open outcry floor is still a critical marketing tool. It's a commitment to the floor broker community, and it provides this public-facing symbol of trust and tradition, balancing the image of high-frequency electronic trading with a century of Chicago market history.
Okay, let's turn to the M&A strategy. This is where Cboe truly transformed from a large U.S. exchange operator into a global conglomerate. And the strategy wasn't just about buying size, was it? It was about buying technology, geography, and data.
The strategy was defined by a relentless focus. Cboe was intent on achieving three things at the same time: geographical diversification, asset class expansion, and technological modernization. They understood that just running an options exchange in Chicago wasn't going to cut it in the fragmented, high-speed 21st century market.
And we should mention that the path wasn't perfectly smooth right out of the gate. I'm thinking of their early venture with the National Stock Exchange.
That's a good point. In 2011, they acquired the National Stock Exchange. And while it operated for a few years, it ultimately ceased trading operations in May 2014. It probably served as a learning experience, though.
That acquisition needs to be strategic. It has to integrate into a broader technology vision.
Which became the guiding principle for all the future deals.
So then, sensing where the future was going, they started building out their crucial data and technology foundation in the mid-2010s.
Yes. They realized that market data and analytics were these high-margin businesses that really complemented their core exchange function. So in August 2015, they acquired the LoveVault platform, a provider of powerful market data services.
And then Vest Financial.
A year later, January 2016, they took a majority stake in Vest Financial, which is an option-centric investment advisor. These moves, they signaled Cboe's intent to move beyond simply facilitating trades and to start providing sophisticated analysis tools around those trades.
But the undisputed game changer, the deal that instantly propelled them into the global top tier and provided the technological backbone for everything that followed, that was the BATS acquisition.
The BATS Global Markets acquisition was the mega deal. Announced in September 2016, completed in March 2017, for about US $3.2 billion. This was not a minor acquisition. BATS was already the second largest U.S. stock exchange by shares traded.
And they were known for being a technology company first, right? Incredibly fast, low latency, cutting-edge tech.
Absolutely. So if Cboe was the traditional established brand, BATS was the high-speed technological disruptor they bought to accelerate their own capabilities.
So the strategic rationale was manifold. Immediate, massive expansion into U.S. and European equities markets, cost-cutting efficiencies, extending their product lines.
But the most profound impact, as you mentioned, was the technology. Cboe recognized that BATS had superior infrastructure. So over the next few years, Cboe undertook this monumental task of migrating all its disparate exchange operations.
Including its original option system.
Yes, onto the advanced BAT technology platform.
So that wasn't just buying a competitor. It was like buying a new nervous system for the whole company.
It was.
That technological standardization must have been incredibly challenging, but it was crucial for the next phase of global growth.
It was the foundation. With the BATS engine running the entire operation, Cboe gained the confidence and the capacity to pursue a hyper-aggressive global build-out in the years that followed. And you just have to look at 2020 alone. It was a year of intense acquisition, demonstrating clear intent across data, clearing, and new geographies.
They doubled down on data and intelligence services, which are critical for attracting those high-volume institutional traders.
They acquired two data analytics firms, Hanweck and FT Options, in February 2020 to enhance their proprietary data streams and offerings. They also purchased Trade Alert, which is a New York-based order flow analysis service.
Which shows a commitment to providing the tools that high-speed traders need to analyze liquidity and routing patterns.
Exactly. And crucially, they also strengthened their role in post-trade infrastructure, particularly in Europe.
This is where clearing becomes so important.
Yes, clearing is non-negotiable for market stability. They expanded their footprint by acquiring the remaining 80% stake in EuroCCP, the Dutch clearinghouse. And this was strategically vital, especially post-Brexit, ensuring Cboe had a robust, centrally managed European clearing presence.
They also made a concerted push into North America, but beyond the U.S. border.
Correct. They acquired ManCH Now, a Canadian alternative trading system, or ATS, as well as Beads Trading, which operates a multilateral ATS.
And this addresses that question of market fragmentation we talked about earlier. For our listener, can you briefly clarify why acquiring these ATS venues, these alternative trading systems, is so crucial for a major exchange operator? Why not just focus on the traditional stock exchanges?
Well, in modern finance, liquidity is fragmented. A really significant portion of trading, often large institutional orders, happens off-exchange in these ATS venues. Sometimes people call them dark pools.
And they offer price improvement, minimize market impact for large blocks of shares.
Exactly. So if Imco wants to be a top-tier global market operator, they need to capture that liquidity, whether it trades on the central or lit exchange or in these alternative venues. Acquiring ManCH Now and Bids ensured Cboe could offer institutional clients a full suite of trading solutions.
So that brings us to 2021 and 2022, which saw them really complete the global footprint, pushing into the strategically crucial Asia-Pacific markets.
The global finish line was Chi-X Asia Pacific, acquired in June 2021. And this was a massive move. It immediately established a significant operational presence in Japan and Australia, two of the largest, most sophisticated, and highest value securities markets in the world.
So now they had trading venues running across all three major global time zones and continents?
They did, but they didn't forget Canada either. They further solidified their position there.
Right. In November 2021, they acquired NEO Exchange, another Canadian stock exchange operator.
And that acquisition complemented their earlier purchase of MTCH Now, making Cboe Canada a major competitive force in that national market.
And the final piece of this expansive puzzle involved diving into the newest frontier of finance, regulated digital assets.
Which is essential for any forward-looking exchange.
Yeah.
In May 2022, Cboe completed the acquisition of Eris Digital Holdings, which operated under the ErisX brand.
And ErisX brought a comprehensive regulated digital asset framework, a spot market, futures, a clearinghouse.
The whole package. A spot market for crypto, a regulated futures exchange for crypto derivatives, and a clearinghouse. And this business was then rebranded as Cboe Digital.
This wraps up a truly incredible M&A timeline. From 2016 to 2022, they effectively bought a global conglomerate spanning all asset classes.
It was a monumental acquisition spree. It defined Cboe's decade. They went from being a large U.S. options and futures operator to a truly global, multi-continent, multi-asset financial market utility in less than 10 years.
So now we have to look at the reality of operating that incredibly complex machine. Let's take a snapshot of Cboe's operations today. When you integrate that many venues across that many jurisdictions, what does the resulting organism look like in terms of sheer market presence?
It's truly vast. Cboe operates stock exchanges in the U.S., Canada, the Netherlands, and Australia. In North America, they established a major footprint. Cboe Canada currently handles about 15% of trading volume in listed securities.
Which makes them the second largest exchange operator in that country.
It does, and in Europe, their acquisitions have given them a dominant position among the multinational operators.
Cboe Clear Europe.
Exactly. Cboe Clear Europe, based in London and Amsterdam, operates the largest stock exchange group in Europe by volume. Globally, Cboe ranks third in the U.S. by volume, but their geographic diversification means they are a critical player everywhere they operate.
And despite all that geographic expansion, what are the most critical high-margin products that still define the Cboe brand at its core?
Their proprietary intellectual property. That remains the cash engine. Beyond standard equities and options, their key index options are the absolute differentiator. We're talking about options on the VIX, which tracks market volatility.
And the big one, options on the S&P 500 index, the SPX.
The SPX. These products are complex, highly valuable, and they drive the sophisticated hedging and speculation that defines their highest margin business segments. At the end of the day, they own the ecosystem of fear.
Okay, now let's pivot to the very recent history. Because this story of relentless expansion gives way to a story of internal scrutiny and a rapid strategic pivot. And leadership changes often precede major shifts. Cboe saw one recently.
It did. Frederick Tomczyk, who served as CEO from 2023 to 2025, was succeeded in May 2025 by Craig Donoghue. And leadership transitions at this level almost always involve a thorough review of past strategy and a potential course correction.
Often in response to internal or external pressures.
Oh.
And speaking of external pressures, this transition happened in the context of very specific regulatory scrutiny and conflict of interest allegations that surfaced earlier in the year involving Cboe member firms.
And this is where the complexity of being a market operator that is also a self-regulatory organization or an SRO, this is where it comes into sharp focus.
Because as an SRO, Cboe is tasked with regulating its own members.
Which creates inherent conflicts of interest if it's not strictly managed.
Now, we must be very careful here and strictly report on the impartial content of the complaint that was filed in 2024. What were the core details of that?
So in 2024, William Carlson, who is the founder of Belvedere Trading, a high-profile Cboe member firm, he filed a complaint with the Illinois Attorney Registration and Disciplinary Commission, the ARDC.
And this complaint was against Mark Francis Duffy.
A former director at Cboe Global Markets, yes.
And the allegation centers on Duffy's dual role.
Precisely. Carlson alleged that Duffy failed to act on significant evidence of financial misconduct at Belvedere Trading. And the central conflict was that Duffy served simultaneously as the firm's external legal counsel and as a Cboe director.
That dual capacity immediately suggests a conflict where, your fiduciary duty to the firm might override the regulatory duty you have to the exchange itself.
That's the crux of the complaint. Carlson specifically suggested that Duffy's dual role may have potentially undermined objective oversight, that it contributed to continued financial irregularities at Belvedere Trading by essentially providing cover.
Which raises deep questions about the integrity of the whole SRO mechanism when internal conflicts are present at the highest levels.
It does, and the situation escalated further in 2025, right before that CEO change.
Right. In June 2025, Carlson made the allegations public.
He did. He accused individuals associated with Belvedere and Cboe of participating in a $35 million equity fraud and cover-up scheme. And Carlson claimed that Duffy was made aware of the misconduct as early as 2011, yet failed to take appropriate action despite his position and his compensation to review the case.
And Carlson was quick to link this alleged internal fraud directly back to Cboe's role as the regulator.
Yes. He emphasized that the implicated individuals in Belvedere Trading itself were Cboe members. And this emphasis puts Cboe self-regulatory oversight directly under the microscope.
Because if member firms are alleged to have engaged in long-running fraud, and those allegations are tied to potential conflicts of interest within the exchange's own governance structure,
it introduces major governance and reputational risk for Cboe Global Markets, no question.
That backdrop of regulatory scrutiny provides some powerful context for the sudden and frankly dramatic strategic realignment announced later in October 2025. It's an abrupt reversal of everything we've just spent the last 15 minutes detailing.
It is a fascinating and a very sharp pivot. After years of aggressive accumulation to build a global exchange conglomerate, Cboe announced a major strategic realignment in October 2025. They declared their intention to sell off their Canadian and Australian businesses.
The Canadian and Australian arms, which they had just spent years and significant capital acquiring through deals like Chi-X, Asia Pacific, and NEO Exchange, they were suddenly deemed non-core.
It's a complete 180. And the company also concurrently announced plans to exit the U.S. and European corporate listings market. They are effectively shedding recent, hard-won global territory
Including major APAC and North American operations.
and simplifying their structure dramatically.
So what does this rapid contraction tell us about the viability of that previous expansion strategy, especially given the increased scrutiny on their regulatory oversight?
It strongly suggests that the complexity, the cost, and the regulatory burden of managing a sprawling, multi-continent, multi-regulatory regime conglomerate may have exceeded the expected benefit.
So when a new leadership team takes over amid regulatory questions,
The safest strategic move is often to de-risk, to refocus on your high-margin core assets.
which, in Cboe's case, means focusing back on their foundational strength, U.S. options, futures, and their proprietary VIX and SPX products. These are high-value, high-margin, and central to their Chicago identity.
Exactly. The decision to sell off equities operations in Canada and Australia and to exit the corporate listings business globally, it signals a move towards specialization and away from comprehensive diversification. It suggests a focus on the intellectual property and the derivatives trading excellence that Cboe pioneered, rather than competing across these disparate, lower-margin, regional equities markets.
That brings us to the end of this deep dive journey then. From a handful of traders in a smoke-filled room pioneering standardization, through the mathematical revolution of the VIX, a massive decade-long acquisition spree, and finally, a dramatic strategic contraction. Driven perhaps by the realization that compliance complexity had overwhelmed the operational benefit.
To synthesize it all, Cboe really went through three major acts. First, standardization that created the modern, fungible options market. Second, intellectual innovation, inventing the VIX and creating tradable variance products. And third, the aggressive global acquisition strategy that made them a multi-asset giant.
And this current act, the strategic contraction, is the most intriguing. So what does this all mean for you, the listener?
Well, Cboe's evolution shows that even successful, large-scale financial innovation creates these complex governance challenges, particularly when you're balancing global reach with the fundamental regulatory duties of an SRO. They spent billions to become a global one-stop shop, but regulatory pressures and the sheer difficulty of integrating all those disparate markets led them to contract sharply just a few years later.
The market, it seems, may be punishing complexity and demanding a return to core expertise.
That is profound context for anyone tracking the modern exchange world. It's not just a technological race. It's a governance and strategy balance beam.
That's right. And to leave you with a final provocative thought, one that builds directly on this tension between global M&A and self-regulation.
We saw Cboe aggressively acquire global markets like Chi-X Asia Pacific and then announce its intent to sell those arms off just 4 years later. This rapid, expensive pivot raises a fundamental question about the future.
Which is?
What does this tell us about the long-term viability of these complex, global, multi-continent exchange conglomerates? Especially when the exchange has to balance relentless technological innovation and high-speed growth with the critical but often internally compromised duty of self-regulatory oversight. Is the future of finance centralization, or is it specialization? Something for you to mull or explore on your own.